Our next guest says the Fed needs to continue to be more aggressive and supports a 50 basis point move at the next meeting.
In an environment where, in fact, the inflation numbers, where people say they look so good and they're getting better, that's very true about the headline inflation numbers. But we still have a long way to go in terms of underlying inflation, getting it back to 2%.
In the last year, of course, with the appearance of the inflation and the increasing of rates to try to stamp out the inflation, things have gotten harder.
An increasing number of economists are expecting recession this year. At this point, is the hope of a soft landing just wishful thinking?
The market has a very optimistic view that inflation is just going to melt away. But the thing is, the Fed says it's not done raising interest rates. Yet, Wall Street and investors seem to minimize the chance of a recession and expect lower rates this year. Which one is right? What to expect from the Fed's February meeting? Well, to answer all your worries away, today, in this video, Cathie Wood has shared her opinion on the Fed's next move. So stay tuned until the end to see her viewpoint on 2023 inflation and the economic outlook. And if you haven't joined our community yet, be sure to subscribe to my channel for more videos like this. You can also hit that bell icon to never miss out on any video. Let's dive into the video now.
If you had told me that oil prices would be cut by nearly half from their peak last year, and that interest rates would be down into the mid threes from 4.25 at their peak last year in terms of the long-term Treasury yield, I would have told you that growth stocks would have had a wonderful end to the year. And of course, that did not happen. It did not happen because it seems as though investors are waiting for permission from the Fed. On February 1st, we'll probably see another 25 or 50 basis points. So we will be at 4.75 or 5%. Now, most of the Fed governors are saying roughly 5%, maybe a little bit more, and then we're done. Maybe the Fed will start talking a little bit more about some of the very significant declines in inflation and outright prices.
With inflation cooling from painful highs, investors are betting that the Fed will stop hiking rates soon, pause for a bit, and then start cutting rates towards the end of the year. That relatively optimistic view has helped propel the broad S&P 500 stock index and crypto prices up so far this year. Still, many Fed policymakers continue to comment that rates are likely to rise to over 5%. That's in contrast to what the market is expecting. The gap between the Fed's projections and investors' expectations could have far-reaching consequences for Americans' finances as well as for the economy. For investors, rate cuts serve almost like hits of steroids. They make borrowing less expensive, and they typically juice prices for everything from stocks to bonds to cryptocurrencies. According to a recent Reuters poll, most economists predict there will be at least one additional rate hike in the first quarter before the Fed lets off the gas. Will the next Fed rate hike be the last in 2023? Will the Fed deliver two 25 basis point hikes in Q1 as per expected? Let me know your thoughts in the comments below. Also, before jumping to the next clip, be sure to give a big thumbs up to this video.
This is a very unusual period. In fact, in my career, I've never seen it go negative. And I've been in the business for nearly 45 years. So this is uncharted territory. And in fact, the last time we saw meaningful declines in the money supply was in the Great Depression, which was, of course, a very deflationary period. So it's very interesting to hear the Larry Summers of the world hearkening back to the 70s in terms of expectations for inflation. The Fed funds rate went to 4.5% in December, and it does appear that the Fed is determined to take it up again. They want nothing to do with a legacy associated with inflation. And as we've suspected for some time, they are unanimous because there are people like Larry Summers out there saying, you're going to be responsible for another run at 70s style inflation, which was highly destructive. And many times I've mentioned here that the 70s inflation is nothing like the inflation we just experienced. The 70s inflation started in the mid-60s with the Vietnam War, with the Great Society programs, one after another, and then we went off the gold exchange standard and lost all discipline. That's nothing like what we've been through. We have been through a massive supply shock, two of them, COVID-related, and then the Russia invasion of Ukraine. Very different circumstance. One led to lasting inflation, and this one, we believe, as I've mentioned many times before, will be much like what we saw in the early 1920s after a pandemic and World War I. Inflation collapsed. It actually ended up at negative 15% in June of 1921. And we do believe this year we're going to drop below 2%. And in fact, the bond market believes it. The bond market's break-even rate is 2% for the next 10 years. In other words, the bond market is expecting 2% inflation for 10 years. And this is the Fed's goal. The bond market thinks we are already there. And in fact, we believe the bond market will continue to rally, meaning long-term interest rates coming down relative to short-term interest rates, inverting the yield curve. Right now, we're at 70 basis points, a little more than that. And it is interesting now to watch the bond market disengage somewhat from the Fed's rhetoric. And the stock market has not done that yet. In fact, the stock market is behaving like the Fed is right. The energy sector is reaching for all-time highs, even though oil prices peaked in 2008, and we believe are in secular decline.
Since the 1990s, the Federal Reserve, the European Central Bank, and other central financial institutions have sought to prevent runaway inflation, setting a target inflation rate of 2%. As inflation soared over the last year, reaching a 40-year U.S. high of 9.1% in June, the Federal Reserve and other central banks have raised interest rates in an effort to bring it back down to the 2% target. Inflation has cooled off a bit, but still, many Fed officials and experts believe that inflation is still going to be well above the targets set by the central banks and will stay high in 2023. Cathie Wood also believes that what we are seeing right now is more similar to stagflation in the 1970s, which was combined high inflation with disappointingly uneven economic growth. Former Treasury Secretary Larry Summers also warned that backing down on interest rates as a means of controlling inflation could precipitate a 1970s-style economic crisis. This is the story of the painful period in the 1970s, which began in late 1972 and continued until the early 1980s. Let's get into the next clip to hear from Cathie Wood regarding the issue of inflation and the Fed's rate hikes.
One other thing to note about monetary policy, it's very influenced these days by Keynesian economics and something called the Phillips curve. Phillips curve basically suggests that if employment is strong, then that will lead to inflation. The history of the last 40 years, however, is the opposite. Employment was pretty strong when you adjust out for recessions, pretty strong for the last 40 years, and yet inflation and interest rates came down quite a bit from mid-teens in the early 80s to 0.5% during COVID. So the history of the last 40 years does not support the Phillips curve, and yet it is interesting to listen to the Fed say, wow, employment, we got to get it down, otherwise wages are just going to take off and become embedded in the system. That was the 70s experience, but it has not been the experience since then, and we do not believe we're in anything like that environment, as I just mentioned. And now the reason it's wrong is when employment is increasing, employment and output are increasing. If they're increasing in a healthy way, then productivity is increasing as well. And we've had a lot of dislocations associated with supply chains recently, so it's very hard to tell where we're going to settle out in terms of productivity. But we do believe, if we're right on how much innovation is taking place, that productivity is going to start scaling in a surprising way. and take the sting out of inflation fears completely. So just wanted to share that with you.
Many Fed officials point to the robust job market as a factor likely to keep inflation high. The unemployment rate, now at 3.5%, hasn't been lower in half a century. Many traders also say they expect the Fed to blink once unemployment begins to steadily rise while inflation is falling. With potentially millions of people facing layoffs, the Fed would be under pressure to begin cutting rates to try to stimulate the economy. To conclude, we are nearly a year into the Fed's drive to quash inflation by hiking interest rates at a blistering pace. Still, investors don't seem to fully believe what the Fed warns is coming next. The market anticipates that the Fed will hold rates steady or even begin to cut them later in 2023. Some Fed officials see pandemic imbalances improving and want the data to dictate how much more action is needed. Others have a more hawkish outlook because they worry inflation will be sticky. For now, no one is ready to call for a pause in the tightening cycle. So, could there be higher rates through the end of the year? Are we witnessing 1970s style inflation? What will be the Fed's next move? Let me know your thoughts in the comments section below. And for more videos on crypto, the market, and economy, be sure to hit that subscribe button. Also, don't forget to give a big thumbs up to this video. I'll see you guys in my next video. Adios, and thanks for watching.